Hello, my name is Fred Sade, and I'm the managing partner at Money Matters USA. And today I thought I would share some thoughts that I have about what does the events in Afghanistan and COVID-19 mean to you. Should you be worried about Afghanistan? After all, it is political risk. It's in the system, hard to defend against. And should you be worried about COVID-19? If you're an investor, if you're serious about planning for retirement, or you're actually in retirement, well, stay with me and see what this could mean for you. Well, today, markets are ignoring Afghanistan. Markets are totally unfazed by the Taliban's return to power, and they're unfazed by the Taliban's imposition of their version of their religion. As a matter of fact, the reaction in the stock and bonds market makes it clear that investors agree with President Biden that it was time to leave. Now, there was a little impact on treasuries. People just ran to treasuries as a safe place to go, but there was no real impact in the stock and the bond market. And whatever slowing in that the economy is experiencing is completely and totally unrelated to Afghanistan for now, but is related to COVID-19. Now, we did think that COVID-19 had a finish line. We would get to that finish line and everything would be done. Turns out that is not the case. We are seeing a slowdown in the economy. It's especially evident on the demand side. We saw that the Federal Reserve canceled a live version of its Jackson Hole meeting, so that tells you that the Fed is also concerned with COVID-19, and particularly the Delta variant. Austin Goolsbee, who was President Obama's chief economist for a period of time, and is a professor at the Booth School of Business at the University of Chicago, he's done a number of studies on each wave of COVID-19, and now we're in wave number 4. And Professor Goolsbee, Dr. Goolsbee, has said that his research shows that in blue states, the $300 extension of employee benefits have not made any impact whatsoever. Made no impact on whether or not people went to work or they didn't go to work. And what he has found is that he thinks that the COVID-19 Delta variant is causing people to be real cautious and stay home. It's a problem for employers also. They want employees to come back to work, and on the other hand, they don't want to be responsible for employees contracting COVID-19. What Professor Goolsbee found is what dropped is people's spending and their use of credit cards. Particularly credit cards dropped markedly. Now, we know that there's a University of Chicago study found that 2 million people have decided to retire during the pandemic and not go back to work. Want to enjoy life, want to survive the pandemic, enjoy their retirement. And this is starting at about age 58. So that means we're now looking at a 30 or even 40-year retirement, a lot skinnier than a 5, 7, 10, 12, 15-year retirement that we might have seen a generation ago. We're also seeing a slowdown in travel. People are canceling flights. Airlines are cutting back on the availability of flights. Employers are cutting back on the necessity for travel. All this has an impact. What about going back to school? Well, that has an impact too. because lower income women need that paycheck. They need to be able to go back to work. And their kids need to go back to school. Kids need to enhance their education. And it's a problem. Many of them have been challenged to obtain and advance their education just by being virtual. All this is an issue. What do we think about the Federal Reserve beyond what I have said? Well, we know that the Federal Reserve is targeting its bond buying program, and it's saying it's going to slow it down. How much is an open question. We know that Morgan Chase says that they believe that the Fed will still put $1 trillion into buying bonds. Whether or not that's accurate or not, nobody really knows until we see what the Fed actually does. But tapering is not the same as stopping. Will the Fed raise interest rates? Hard to say. There's a limit to what the Fed can do. German interest rates are still negative, and European interest rates are still very low. So I think the Fed has to be very careful. It's going to be walking on eggs, if you will, because they don't want to further antagonize our European allies and friends who are still very upset over Afghanistan. So my guess is the best case will be about a 2.25 to 2.50 on the 10-year Treasury, and I think that's going to make Wall Street very happy to see that. Now, since interest rates have tweaked up a little bit, that means that the cost of bonds has gone down, and it means that yields have gone up a little bit. Well, what does that mean? What does this mean to you? I mean, if you're an average investor, or you're a do-it-yourselfer and you've had some success, or even if most of your money is in managing your 401k and your IRAs, maybe you have brokerage accounts as well, you've been doing some Roth conversions, been trying to pay attention to some of the things that are going on in terms of potential tax changes brought about by various bills that are in the hopper, and most of these have been consolidated into the 3.5 trillion so-called bill, whatever you want to call it, the stimulus bill. I think one can argue that with all the stimulus that's been pumped into the economy, really hasn't been used very well. There's been this push-pull. On the one hand, we have the stimulus going in, monetary and fiscal stimulus. On the other hand, we have all the COVID restrictions, the concerns about COVID. I'm not saying that we shouldn't be concerned about COVID, but that's a reality. So we're not really effectively using all that stimulus that's going into the economy. There's too much push and pull, too much conflict between the two that's going on. Now, to come back to the real issue here is, what does this mean for you? What does it mean for your retirement? And now, again, in my opinion, it's important to use every possible avenue to improve retirement outcomes. It should be evident and obvious, but I'm saying it anyway because I'm not so sure that it is. The risks are very great if your strategy is simply to withdraw money from accounts, because if you have to experience sequence of risk, that is an extremely rapid decline in the early years of your retirement, the first 2 or 3 years of your retirement, the likelihood of your running out of money increases exponentially. And I would say the first 2 or 3 years prior to retirement, you still have the same probability of having premature failure. That is, running out of income, running out of assets. So what are the tools that you should use? Well, here are the 4 tools that I suggest. 1, better returns, taking into account sequence of returns risk and taking this real seriously. 2, better upside and downside capture, and I'll explain that in a minute. better participation when the market is going up, and better reduction of losses when the market is going down. So the real issue here is, how do you improve on a portfolio's beta? What's a beta? Well, a beta is a measure of a stock's volatility in relation to the market as a whole. Now, in my opinion, and there's plenty of academic research that supports this opinion, so it's just not me saying this, annuities, particularly fixed income annuities and sometimes deferred income annuities, can provide improvements in the performance of a portfolio. Now you say, how could that be? Well, it's simple. If you can get more money out of a lesser amount of money, that frees up the rest of your portfolio to be invested, so you don't have to worry about running out of income. Now, here's an example of what I'm talking about. Monte Carlo simulation on fixed income annuities using the traditional 60-40 portfolio found that over 98% of the time, and the fixed income annuity could improve performance by 9.9% when the markets were up. What does that mean? Well, it means that you have a 10% withdrawal rate on income and not a 4% withdrawal rate. And if you don't like the 4% Bengen static rate, then it's still better than guidance, guideline rates that still limits you to a mid-5 withdrawal at a maximum, and only when the markets are up. Well, the fixed index annuity is independent of the markets, because for the most part you're working with compound interest on the income account. So that the compound interest doesn't depend on the performance of the stock market. So a fixed index annuity can allow you to build more assets because you've taken care of the income part. So you now have guaranteed income from Social Security and guaranteed income from a fixed index annuity, which can serve as a pension. So you've handled that problem, and you don't have to use glide path theory. Now, glide path theory says that as you age, more of your portfolio is going to shift to bonds to get fixed income, but you don't need glide paths because you've got the fixed income from the fixed index annuity, which will outperform the bond or the 60-40 portfolio. So if you're going to prioritize income, you don't want to run out of income, you don't want you to exhaust your assets, and we haven't even touched about the amount of money that it costs for healthcare in retirement. The latest Fidelity study is saying that it will cost in the neighborhood of $300,000, and that doesn't even count for long-term care. But if you can rely on a guarantee, that's going to improve your spending rates in retirement. If you'd like to get our free checklist on what you should be concerned about to protect yourself for COVID-19, contact me, Fred Sade, at Money Matters USA, and call us and give us a valid email address, and we will be happy, without obligation, to send you our COVID-19 checklist. Fred Sade at Money Matters USA, 908-791-3831, 908-791-3831. This is Fred Sade, and I hope you take care of yourself and stay well.